The UK just killed the non-dom status and with it, a 200-year-old tax break used by the world's wealthiest. What does it mean for you? In this video, we break down the new tax rules, the FIG regime, and why billionaires are packing their bags for Italy and the UAE. Let's dive in. This year, the UK introduced major changes to its tax system, most notably a significant overhaul of the non-dom regime. And the impact is anything but minor. 1. The end of remittance basis. 2. The introduction of the foreign income and gains (FIG) regime. 3. Transitional reliefs for existing non-doms. 4. Shift to residence-based inheritance tax (IHT). 5 changes to trust taxation. We'll walk you through the first 4 key points shortly, setting aside the topic of trusts for now. But first, a quick look back. Until April 2025, the UK tax system distinguished between domiciled and non-domiciled residents. If you were domiciled, you were taxed on your worldwide income and assets. Non-domiciled individuals, on the other hand, were taxed only on UK-based income and gains unless they brought foreign income into the UK. However, after residing in the UK for more than 15 of the past 20 years, a non-dom was treated as domiciled for tax purposes, triggering worldwide taxation. The UK's non-dom status has been in place for over 2 centuries, originally introduced in 1799 during the Napoleonic Wars. It allowed UK residents with a permanent home abroad to avoid UK taxes on foreign income and capital gains, provided those funds weren't brought into the UK. This principle became known as the remittance basis. Under this system, only income generated within the UK was subject to tax. Foreign earnings remained untouched unless remitted. Over the past few decades, this regime proved especially attractive to individuals relocating from high-tax countries such as France, Spain, and Belgium. The appeal was clear. Expats could legally avoid UK tax on their offshore income as long as they didn't transfer it into the country. In effect, the non-dom regime offered a hybrid of 2 major tax philosophies: territorial taxation, like in Panama, Paraguay, or Georgia, where only local income is taxed and foreign income is ignored; and residence-based taxation, where global income is taxed purely based on where you live, often a much heavier burden, unless the local tax rates are low, as in Bulgaria, Poland, or Romania. Of course, there are exceptions, particularly in cases where double tax treaties apply. However, we won't delve into that topic today. The non-dom status was undeniably generous. Not only could foreign income legally escape UK taxation unless remitted, but offshore assets were also excluded from the scope of UK taxes. Inheritance tax, for example, applied only to assets located within the UK. It's no surprise then that many wealthy individuals chose the UK as their base. The opportunity to earn and hold wealth abroad completely tax-free under UK law was incredibly appealing. And most importantly, it was entirely legal. Domiciled residents, in contrast, didn't benefit from such exemptions. Their worldwide income and assets were fully taxable under the UK's residence-based system, similar to what you'd find in many other countries. But now, as mentioned earlier, all of that is changing. The non-dom status is coming to an end. So, what's actually changing this tax year? Quick pause. Support our channel. Before we continue, can we ask you a small favor? If you're finding this video helpful, please subscribe to our channel and give us a thumbs up. It really supports our work and helps boost our visibility across social media platforms. Thank you. Let's go back to out video. Now let's talk about the replacement of the abolished non-dom regime, the FIG. The FIG offers 2 temporary options. Firstly, there is a new 4-year exemption on foreign income and capital gains for new arrivals. It gives full exemption, provided you have not been UK tax resident in the previous 10 years. After the 4-year exemption, you become fully taxable on foreign income and gains as they arise, like other UK tax residents. You must register with HMRC, and disclose foreign income gains annually via a UK tax return. Beware for non-compliance. Undisclosed foreign income gains during the 4 years become fully taxable retroactively. Secondly, a transitional relief for existing non-DOMs. For current UK residents who don't qualify for the 4-year FIG exemption, there is a 1-year transitional relief available for their tax year 2025-2026. This relief offers a 50% reduction in the tax due on foreign income and gains. Therefore, these two temporary FIGs address, on the one hand, the new residents, and, the other hand, existing non-DOMs. More on inheritance tax. So, what does shifting inheritance tax, IHT, to a residence-based model actually mean? Even if you move your residency out of the UK, you may still be liable for UK inheritance tax for a minimum of 3 years and up to 10 years, depending on your past UK residency. Let's break it down with an example. Imagine you've been a UK resident since 2005. That's 6 years of residency. Now, in 2025, you decide to relocate and become a tax resident in Italy. Here's how UK inheritance tax would apply. You're automatically subject to IHT for 3 years, 2025, 2028. Then, 1 extra year is added for each year of UK residency beyond 10 years, up to a cap of 10 years total. In this example, you've been a UK resident for 6 years more than the 10-year minimum, so IHT will continue to apply for a total of 6 years after departure, that is, until the 2031-32 tax year. On the other hand, if you've lived in the UK for less than 10 years, say since after 2015, you can avoid this extended IHT exposure entirely. That's why it's crucial to act quickly if your UK residency is approaching the 10-year threshold. The decisions you make now could have a major impact on your estate planning down the line. As you see, many changes will be applied starting this tax year, 2025-26. What can you do? You can start looking where to go and minimize the 10 years, minimal stay over the previous 20 years. Some countries offer flat tax regimes based on residency, for example. Bulgaria applies a 10% flat income tax. Alternatively, high net worth individuals, HNWIs, may benefit from special tax programs where a fixed annual lump sum tax is applied to offshore income. Italy, for instance, offers such a regime with a flat €200,000 yearly tax on foreign-sourced revenue. Malta and Cyprus continue to offer non-DOM regimes, making them strong contenders if you're looking to maintain that status elsewhere. In summary, you have several strategic options. You can pursue another non-DOM arrangement to continue benefiting from exemptions on foreign income. You might consider countries with territorial taxation systems like Panama, Paraguay, or Georgia, where only local income is taxed. Or you could opt for true tax havens, such as the UAE, which imposes no personal income tax at all. Ultimately, the recent UK tax reforms have prompted many ultra-high net worth individuals to give up their UK residency and relocate to jurisdictions with more favorable tax environments, most notably the UAE, where there is no personal income tax. So, where are the wealthy heading when they leave the UK? Just yesterday, the Financial Times reported that another billionaire, Richard Nod, a top Goldman Sachs executive, has chosen to move to Italy, joining the growing trend of high-profile exits. We hope this video has provided some clarity or, at the very least, raised important questions about your UK residency status. If you're exploring ways to minimize your tax burden, Bantha Tax is here to guide you. And if leaving the UK isn't an option, we can help you understand how to reduce your taxes while staying compliant. Send us an email at info@banthatx.com. We are eager to hear from you.